welcome to the deal filter system video. And this is actually the last video of the deal flow module 3. And by the end of this video, you're going to be able to look at any storage deal and know within minutes if it's worth your time. Now, I want to be clear about something. This is meant to take you from confusion to give you confidence and clarity. So this isn't meant to go full deep dive underwriting where we're looking at everything from like every little line item of expenses and everything. This is the deal filter system. It's a simple 5-minute process to see whether the deal deserves a deep dive or not. In fact, I've gotten coaching clients that are so good at this that within 1 to 2 minutes, they're able to determine, hey, let's dive deeper, or hey, let's just pass on this. Now, again, the goal is to build confidence and speed. We're going to filter fast. We're going to find the truth in the numbers, and we're only going to focus on where the returns justify the work. So here's step 1 of this process. And step 1 is more about zooming out. You know, now that you've been equipped and you have your buy box blueprint, right? You understand your market map, the map it framework that we talked about in module 2. I want you to ask yourself here, before you even touch a spreadsheet, before you look at the numbers, is like, when you look at a deal, does it fit your buy box blueprint? With regards to market size, what's the story of the mom and pop? Like, where is their potential value add? Do they not have automation or marketing or a website? Remember, we talked about the storage scan? Those are some of the things I just want you to think through. But if you just want to look at any storage facility and just determine within a couple of minutes if it makes sense to dive deeper or not, I want to introduce you to something I call the filter framework, which is very on brand considering that this video is called the deal filter system. Well, this is the filter framework, and this is just a simple mental model that I put together that helps keep you focused and consistent. Now, I'm just going to quickly touch on what each letter of the filter framework is, and then I'm going to specifically dive on one area, which is the T, and that is where we're rolling up our sleeves and we're quickly looking at the numbers. So the F is find the facts. And I want you to start with what's real. You may or may not have a lot of information, but if you just have the revenue, if you can estimate the expenses, and we'll talk about that here, you can just quickly get to the truth. So it's just like, hey, what are the facts here? The I is investigate the market, because demand drives value. And it's important that when you're looking at a facility, especially one that you want to actually purchase to own and operate, you need to understand what's going on in that market. What's the median household income? Where's the population? You have to know if there's demand for storage, like the supply and demand, or what's called the supply index. Is the market shrinking and contracting, or is it growing and expanding? Super, super important that you understand what's going on in the market. Now, if you're just looking to wholesale, it's probably more about price and or terms, getting the right deal that has enough meat on the bone so that you can find the right end buyer for it. The L in the filter framework is look for leverage. Okay, where can we move the needle? Are the rents below market? Do they not have any fee income like tenant protection, late fees, auction fees, admin fees? Is there no website? So where can you potentially go in as an operator and increase the value of the facility? Now, the T is for test the math. And this is where we're going to spend the majority of our time and energy in this particular training. And this is where you really discover what the facility is truly worth based on income and based on something called a cap rate. And don't freak out. I don't want to throw too much industry jargon in terms your way. I'll easily explain what a cap rate is. And I don't care if you failed math or if you are the worst when it comes to numbers. I've made it super, super simple and easy for you. So don't freak out on me. The E in the filter framework is exit strategy. You know, one of the things I learned early on from a mentor was before you even buy a deal, you have to understand the exit. Okay, so think about this ahead. Is this a facility that you want to hold for cash flow? Do you want to do a cash out refi in 12 to 24, 36 months? Do you want to stabilize it, meaning you want to increase the occupancy, generate more revenue, increase the overall value of the facility, and then sell it so that you can capitalize on all that value you created? Because clarity at the end of the day really is going to shape how you're going to buy it. When I bought my first and third storage facility in Mississippi, I knew that it wasn't a facility that I wanted to hold on to long-term for cash flow because I just didn't want to be in that market. It was a facility I intentionally bought to increase the value, to turn around and sell it within 18 to 36 months. And that's exactly the strategy that I executed on. The R is for ready to offer, comma, refine or reject. Okay, ready to offer. In other words, you're ready to go ahead and send an offer via an LOI, a letter of intent. And we have a specific training on how to put together an LOI in the amplifier training section. So don't skip ahead. I just wanted to make that known. You're ready to make an offer. You need to refine some things, or you're just going to go ahead and reject once you've reviewed the numbers. Okay. If it fits, you move forward. If not, you refine it or you cut it loose, and momentum beats perfection every day and twice on Sunday. So now let's really hone in on the T in the filter framework, which is test the math. I need you to understand that unlike the residential world, where the value of a single family home, the value of a house is determined by comps, comparable sales, in storage and in commercial real estate, the value of the asset is determined by the income that asset generates and produces. So when we have something called revenue, right? That's all the gross rents, that's any fee income. So that's the gross revenue minus expenses, which are the expenses it takes to operate a storage facility. And I'm going to talk about that and elaborate a little bit more in just a few minutes. That gives you the NOI, the net operating income. So now understand that revenue minus expenses gives you the NOI that doesn't take into account debt. In other words, if you went to a bank and you got a loan, you have something called debt service that doesn't factor debt service into that equation. It's just the gross revenue minus the expenses that it takes to operate that storage facility in that business gives you the NOI, the net operating income. The value of that asset, in other words, the value of that storage facility is determined by the NOI. If you increase the NOI, the value of the facility goes up. If you decrease the NOI, the value of the facility goes down. So it's really, really important that you understand that in storage, we're not going out there and checking comps. We're not checking comparable sales. We are looking at the NOI, which is the net operating income that asset produces. That is what drives the value. And you're going to see here, because I have a cash flow maps cap rate calculator and offer range calculator that you're going to get as part of this course, which is going to make things really, really easy for you. Now, in storage, the operating expense ratio, generally speaking, is between 35 and 40% of the gross revenue. So what does that mean? Let's say that a storage facility generates $100,000 in annual revenue. A facility generates $100,000 in annual revenue. It's going to take between $35,000 and $40,000 to operate that facility, the expenses it has. Taxes, insurance, your boots on the ground, if you have a manager, things of that nature, okay? Utilities, etc. So 35 to 40%. Now, a couple of things that you should know. If it's a larger facility, then it could be a lot closer to that 35% number. In other words, as a general rule of thumb, the larger the facility, the lower the operating expense ratio. The smaller the facility, the higher the expense ratio. So I like to be between, when I evaluate deals, I usually plug in 37 to 40% operating expense ratio. If you're in a rural market, right, then expenses could run heavier. Or if you're in a smaller market, because you just don't have the economies of scale, you're limited there. So just as a general rule of thumb, for every dollar of revenue that a facility produces, it's going to take about 35 to 40 cents of that to operate it. Hopefully that makes sense. Now, let's transition into this fancy word cap rate, which you may already know what that is. You may have heard it. You may have no clue, and you're looking at me like I have 17 heads. Here's the best way I can simplify it. The cap rate is just the expected annual return if you bought the property all cash. So what is the return that you would get on this investment, on this asset, if you bought the property cash? Now, don't worry, I'm not expecting you to go buy these properties cash. I'm not assuming you have the cash to go buy these properties. So forget about that aspect of it. Just understand that cap rate is an expression of value. If a facility cost $500,000 and you bought that facility for $500,000, what is the net return on that investment? That is the cap rate. So let's take a simple example. If you see a facility and they're advertising it as a 10 cap, right? That means that you would earn 10% of your purchase price each year in net income, assuming it was an actual 10 cap. We'll talk about pro forma, and we'll talk about how brokers tend to inflate the numbers and for you not to fall into that trap. So we'll definitely touch on that. But all the cap rate does is it tells a story about the risk profile. It tells a story about the market type. And one thing that I think is important for you to know is that the higher the cap rate, generally speaking, that's going to come with more risk, but it's also going to come with a higher return. The lower the cap rate comes with less risk in theory and a lower return. So if you're in a primary market, like a big metropolitan city like Miami or Los Angeles, right? The cap rates, what they say trade for, means what they sell for, is a lot lower in those markets. It could be, years ago, it was properties were trading at 4 caps. It could be 5 or 6 caps right now. Now, in smaller markets, like a tertiary market or a rural market, the cap rates tend to trade higher, and that could be in the 8 to 12% range. So that's why when we analyze most deals, 8 to 12% is really kind of the range of both sides for the most part. So I'm going to go ahead and I want to share my screen, and I'm going to introduce you now the cash flow maps cap rate calculator and the quick offer range calculator. So check this out. I think you're going to really enjoy this and find this very, very interesting. Okay. So there's a couple different ways that you can go about this. Remember how in the previous video we talked about, like, if all I had was the revenue, either the monthly revenue or the annual revenue, then that's enough for me to make an offer. Well, check out how simple this is and how easy I think we've made it for you here. So right here, all you have to do is, if you get the monthly gross revenue on a storage facility, all you got to do is put it into this cell that's highlighted yellow, and it is going to automatically spit out an offer range based on as high as a 12 cap to as low as an 8 cap. So in this particular example, let's say we were on the phone with a storage owner and they were generating $15,000 a month in $15,000 a month in gross revenue. Then our offer, based, if we were looking at anywhere between an 8% cap rate and a 12% cap rate, would be somewhere between $900,000 and $1.35 million. Now, if you get the annual number, it's just one extra little step. All you got to do is divide that by 12 and then put that number into here. Okay, that way you get the monthly revenue. So let's say they tell you it's $120,000 in annual revenue. Or $100,000 in annual revenue, you divide it by 12, and that number is what you're going to put into the monthly gross revenue number here. And that gives you a range. The other thing you could do is, sometimes we don't have the revenue, but we have the square footage of the facility, because we're able to go on Google Maps and we're able to use the measure distance tool, and we can get an approximation. Well, if we can get an approximation on the net rentable square footage, and we know that in that market, we look at the storage facilities within a 5-mile radius, we look at the websites, and we determine that on average, a 10 by 10 goes for $70 a month in this hypothetical example. Well, what's 10 times 10? That's 100 square feet of storage. If they're asking $70 and most facilities, the rent is $70, all you're doing is 70 divided by 100 is 70 cents a foot. So if you just plug in here in the yellow, the approximate net rentable square footage, and then you figure out what the price per square foot is, it'll automatically give you a projected annual net operating income. Okay, and that's based on a 40% operating expense ratio and based on a 15% vacancy rate. But this is really where I want to take your attention to. Here is the cap rate calculator. So I like this definitely more than this one. This is useful if you don't have any information, but all you do is you have the size of the facility, and then you can look at the competitors to determine what is the average price per foot. This is helpful if you have the monthly revenue number. But here's where this can be extremely valuable. When you're talking to a storage owner, and let's continue to use this $15,000 number. And let's say they tell you, yeah, our facility generates $15,000 a month in revenue. Well, all you got to do is go to this line item here, which tells you $15,000, which is $180,000 in annual revenue. Okay, this is going to automatically calculate the expenses. Now, if you want to adjust it to a 35% expense ratio, all you have to do is right here in this cell that's highlighted yellow, change it to 35% and it'll automatically update this expense column. If you want to put 37%, 39, 40, even if you wanted to put 45%, it would do the math for you. So let's go back here to 15,000 and you can see that right here, based on, it'll give you the value of the facility based on a 12 cap, an 11 cap, a 10, a 9, an 8, a 7, a 6, all the way to a 4 cap. So remember earlier when I said the lower the cap rate, the lower the risk, but also the lower the return? Well, the lower the cap rate, that means it's more valuable. The higher the cap rate, it's coming at a lower price. So what does that mean? When we buy storage, we want to buy at the highest possible cap rate. When we sell storage, we want to sell at the lowest possible cap rate. Here's a perfect example. Check this out. If a facility generated $15,000 in monthly revenue or $180,000 in annual revenue, at a 12 cap, the facility is worth $900,000. But check out the value at a 4 cap, $2.7 million. So this offer range calculator, just quickly, when you're on the phone with somebody or when you have the monthly or the annual revenue, all you have to do is determine what expense ratio you want to use, depending on the size of the facility, depending on the market, like we talked about earlier. And then right here, it'll give you a range based on a certain cap rate. Now, I will say that a lot of facilities these days are probably trading in like the 8 cap, 7 to 8 cap range. But I think it's extremely critical that you understand that when you make an offer based on the current numbers. Don't make an offer based on what brokers will refer to as the pro forma, which is the future value. In other words, oftentimes you'll see on a broker's OM, the offering memorandum, that they'll show you the actual numbers and they'll show you the pro forma. And the pro forma looks really, really sexy and it looks intriguing and the numbers look great. But that is based on if you were to increase the rents, if you were to reduce expenses, if you were to add fee income, and they're expecting you and wanting you to pay for the value that they haven't created. So I don't want you to make offers based on the pro forma. I don't want you to make offers on what it could be worth. I want you to make the offer based on the current NOI, the current net operating income. And this cash flow maps cap rate calculator is a great way for you to determine more or less what's this facility worth today based on the income it's generating. All you need to do is figure out what the monthly or annual revenue is, and then figure out what expense ratio you want to apply, and the cap rate calculator will do the rest for you. Okay. Now, if you have the monthly revenue, now let's cross-check this. So you might be thinking, hey, Alex, why 2 different calculators? Well, one is the offer range calculator and the cap rate calculator. So this just gives you a range. So you kind of know if you're even in the ballpark when the seller says, hey, I'm looking for $1 million. Okay, well, are we even in the range? But let's cross-check it and let's do the math. So this is saying $15,000 in monthly revenue, which means that at a 12 cap, this facility is worth $900,000. At an 8 cap, it's worth 1.35. So let's take a look at this. 12 cap is right here. All right, this column. And let's look at the row for 15,000, which is row 34. So boom, there it is. At a 12 cap, 900,000, which is exactly what we have here. Offer at a 12 cap, 900. Let's look at the offer at an 8 cap. So at an 8 cap, we're going to go right down here. 1.35. There it is. $15,000. So here, let's go ahead and highlight this row. 1.35 is column M, which is at an 8 cap. So the math checks out. So use this tool when you're on the phone, when you're doing your direct contact blueprint. You're doing outreach, whether that's from any type of marketing channel, cold calling, direct mail, whatever it is. All you got to do is get a few key pieces of information, and then you can quickly determine, hey, are we even in the range? What's a property worth? All right. So let me go ahead and stop sharing my screen now and share with you guys a few more things that I think is important. Now, I've shared with you, with just the information you have, you can already determine what the value of a facility is. And with either the quick offer range calculator or with the cap rate calculator, we talked about pro forma. All right. Now, when you look at pro forma, that's the would be. And oftentimes they will bake in lower expense ratios. So if you ever see 15, 20, 25% expense ratios, kind of a red flag, right? If you're talking to a mom and pop storage owner that has 15 or 20% operating expense ratios, that makes sense because they're the ones probably managing the facility. They're doing all the work themselves. But you're not going to do all the work yourself. You're going to have a boots on the ground team member. Or if it's a larger facility, you might choose to go third-party management. So you're going to have expenses that mom and pop storage owner is not going to have. And you need to be able to explain that to them. Oftentimes with pro formas, there's a gap and a difference between the physical occupancy and the economic occupancy. Now, what's the difference between the two? The physical occupancy is, hey, there's a customer that actually has their stuff in a unit, but they're not paying. It's physically occupied, but it's not generating any revenue. The economic occupancy is the percentage that the facility would generate if it were 100% occupied. Let's say we have a 100-unit storage facility, and it could generate $50,000 in annual revenue. Let's just say, for simple math, but it's only generating $25,000 in annual revenue. Well, that's a 50% economic occupancy, right? It's only generating half of the revenue it could generate. Now, it could be 100% occupied. All 100 units could be full, but if it's only generating 25 grand when it could generate 50 grand, it's 50% economically occupied and 100% physically occupied. There's a big difference between those two, and it's important that you know that. Now, look, with all that being said, I got one more calculator, right? And it's really like the street rate gap that I'm going to talk to you about, but I just want you to be 85 to 90% confident. You don't have to be 100% confident. In fact, there hasn't been a storage facility that I bought that I was 1,000% confident on every single number. There's going to be some assumptions that you bake in, but you want to mitigate against the potential risk. You want to run it through the deal filter system. You want to verify income and expenses and then the market, the demands. You want to verify all that, and you want to go through your process and feel really, really confident. But when we look at deals, I never buy a deal based on the best case scenario. I always look at a deal through three lenses. What is the worst case scenario? What is my likely scenario? And what is my best case scenario? I'll never buy on the best case. I usually buy on the worst case because if I can make the numbers work on the worst case scenario, then I know that everything else is gravy and upside. And I'm likely going to achieve my likely scenario. If everything breaks right, that's cherry on top, right? That's the dessert. But I'm never, ever buying on the best case scenario. Now, the last thing I want to share with you, and this is super important, I want you to look at something I call the street rate gap. This is where essentially we're looking at the spread between the current rates and the market rents. So I'm going to give you a simple 6-step system. Number one, I want you to search all of the storage facilities within a 5-mile radius of the subject facility that you're looking at. And you can quickly pop this into a Google spreadsheet. And really for now, all I want you to do is focus on 2 unit types and sizes. I want you to look at the 10 by 10s in the area, and I want you to look at the 10 by 15s in the area. That, when you calculate the average of those, you'll have a really, really strong and firm indicator of what the market price per square foot is. So as an example, let's say that we have 2 10 by 10s. And let's say that we have one 10 by 10 that they're charging 60 and the other 10 by 10 at another facility 70. Well, we can assume pretty safely that the average price per square foot is 65, or the average rent for a 10 by 10 in that market. If one is at 60 and one is at 70, you take the average, that's $65. Now, we'll look at the 10 by 15s. Now, if you take 10 times 15, that's 150 square foot of storage. Now, let's say that a 10 by 15 is one is at 70 and the other one is at 80. So that's 75. All right. Now, in this case, if we take $75 and we divide that by 150 square feet of storage, that's going to give us the price per square foot, which is 50 cents. And so when we take the average of those, we're going to now get the market price per square foot. And we want to be able to compare that to the subject facility. So like, let's say the subject facility, the 10 by 10s, they're charging $40, but they should be charging 65. And let's say the 10 by 15s, they're charging $50, but they should be charging $75. That is a gap. That gap represents value for us. That means that if we were to buy this facility and we go in and all we did was raise the rents to match the average of the market street rates, we're instantly creating value. That's exactly what I did at my Florida facility when we bought this several years ago. We bought it on 90% seller financing, and the rates were literally half of what the average market rates were. So as an example, the 10 by 10s, I believe at the time that we bought it, were at $40, but the average of the market was around $80. So when we bought the facility, we were literally able to go in and double the rates. And we just added significant value and equity to our facility just by bumping the rents and generating more revenue. When you compare to the subject facility, I want you to figure out, multiply the difference by the total rentable square footage to see what the revenue lift is. If all of a sudden we took our 10 by 10s from 40 to 65, what revenue would that generate at $65? Figure that out. Same thing. What if we took the 10 by 15s from, I think we said $45 or $50, and we bumped it to 75, which is the average of the market? How much revenue would it generate? So let's say in the hypothetical, the facility is currently generating $100,000, but if we went ahead and we increased the rates, it would take our annual revenue to $120,000. Well, now at $120,000, apply the same operating expense ratio, which is either 35 or 40%, whatever you're using, and divide it by that number. So we have revenue minus expenses gives us our NOI. The NOI divided by the purchase price gives us the cap rate. Or another way to do it is the NOI divided by the cap rate gives you the value of the facility. I'll give you an example. $100,000, and we were to divide it by an 8 cap. Okay, we'll take $100,000 and we will divide that by 0.08 or 8%. That gives us $1.25 million in value. But let's say we can take the NOI from $100,000 to $120,000. The NOI, not the revenue, the NOI. Well, all of a sudden, remember, the value at an 8 cap on $100,000 of NOI is $1.25 million. Let's see how much more it's worth if we can just increase the NOI by $20,000 annually. So we'll do $120,000 divided by the same 8 cap or 8%. And now that's $1.5 million. So we've added $250,000 in value from 1.25 to 1.5 just by increasing the NOI $20,000 in a year. So you see how it has a multiple effect on the value when we're able to generate more income? That's the beauty of self-storage, where you can't achieve that with single family. When single family, if you generate an extra $100 in rent, it's not adding hundreds of thousands of dollars of value to the property. But in storage, when we can generate more NOI, that's the name of the game. Increase occupancy, generate more revenue, try to reduce expenses as much as possible, and generate the highest NOI possible. That drives the value. And then from there, step 5 is decision time. If the numbers make sense, we'll then graduate to go further, deeper on the underwriting. That's where we're starting to look at the different expense line items. And the deal filter system isn't about perfection. It's about progress. We want to filter fast. We want to focus deep. We want to keep building momentum. And this will give you the confidence to be able to make offers, to be able to put offers on an LOI, to be able to even verbally, hey, Mr. Seller, I'm based on the net operating income, based on the income the asset's producing right now, I'm likely going to be in this range. Would it even make sense for me to put that offer in writing and put the ball back on their court? Now, I subscribe to the thinking that pretty much if they're open to selling, you should make an offer. If you don't make an offer, it's the equivalent of trying to play baseball and not stepping out on the field. All right, so here's what I'd like for you to do. I want you to practice this now. I want you to find 3 deals, find 3 opportunities. I don't care if it's a deal or not, but I want you to get comfortable running the numbers through the cash flow maps, cap rate calculator, and the offer range calculator. And then even filter it through the street rate gap. So now go to the facility, look at the facilities in the market, start looking at the 10 by 10s and the 10 by 15s to figure out what is the market price per square foot. And determine, hey, this is the current revenue, but this is what the revenue could be if I was to buy it and just raise the rents. There's other things we can do like fee income, like tenant protection, auction fees, late fees. All those things just generate more revenue and help us increase the value of the facility. All right. So download the cash flow maps, cap rate calculator, and offer range calculator. And remember one thing, deals aren't really found. They're created, and you could be one deal away from freedom. So that is my plea and my call to action is download that resource, find 3 deals, start running it through it, and just start getting comfortable. Just start saying, hey, what's the monthly revenue? What's the annual revenue? Pop it in there. And even if you didn't have it, you could simply do it on your phone. I mean, it's that simple. So I look forward to, now that we've wrapped up module 3, I'm looking forward to hopping into module 4.